Hi everyone. Just a quick update and observation, really based on my experience. A lot of people are looking at the stock markets around the world right now. And in the United States, we've had 1,500 points come off the Dow. You've had a 5% plus correction from the highs. This is healthy stuff. Now, here's the deal about corrections, right? Corrections are fast, they're sharp, they're very scary. It gets rid of people who are really not supposed to be here, it eliminates a lot of excess. However, this virus, coronavirus, has an especially temporary attribute which gives rise to almost a predictable, controlled, orderly backdrop to corrections in financial markets. Usually corrections come out of nowhere. Nobody realizes why they happen until after the fact. One of the things that people are not really looking at, especially those in crypto land, is if you look at rates on a 10-year bond, it's gone the opposite direction of the stock market. And it's done that for the last year. That's a little bit unusual, and that usually tells you that the stock market is, the bond market is seeing something that the stock market up until yesterday has largely been ignoring, right? We're at all-time lows on a 10-year bond. 1.32% is an all-time low. Now, I'm not going to go into all the reasons as to why, but the bond market is 10 times the size of the stock market, even more in some cases, plus all your derivatives. Bond market's where the big boys play, right? I can't take $100 million and move it in an agile manner within seconds in the stock market. You can't do that. I can do that in a second anonymously in the bond market, right? That's where you really move big money around. But in terms of this coronavirus, what you're seeing is a catalyst, which is telling you largely why the market is correcting. So if you take for a moment the possibility or probability that it'll get contained, and World Health Organization, CDC, other agencies around the world will work toward containing it, one could make a very strong case that these are times that you pick entry points in selective assets and you take longer term positions. These are for long-term players. I'm not giving anyone an investment advice, by the way. You know, this is just 30 years of my experience, right? And it takes a long time for people to learn this stuff. I have learned to see certain patterns, behaviors in the market that repeat themselves somewhat. And if they don't repeat themselves, they definitely rhyme. But it seems to be making its way into crypto as well. Like, they're throwing everything out except bonds. And bonds are where you go to hide, right? So high yield bonds act like stocks in that when conditions like this persist, the price of high yield bonds goes down and the yields go up. But with treasuries, the price is going up and the yields are going down. Plus, you've had an inversion between 5s and 10s today. The shorter end of the curve is beginning to invert. You're hitting close to, if not all-time lows on a 30-year bond, but 10s, 30s are not inverted yet. But you should watch the bond market, especially those in crypto land, right? Because we're going to correlate some of this stuff in future videos, you know, when I talk to you guys. I used to trade fixed income, and I'd move around $200-300 million in a single day, very easily. A single click over a Bloomberg or a TradeWeb can move a couple $100 million, right? That's just the way our markets work. The most liquid market is the US dollar. The second most liquid market is a 10-year bond. Or should I say shorter end of the curve. But if you look at what happened in the stock market, you've had a delayed fuse, because I saw people on Twitter asking questions. How come the stock market's not going down in light of softening certain companies that are not meeting earnings expectations, plus this coronavirus? I don't understand it. The stock market experienced the same type of delayed fuse in late 2008. Stock market was trading around 11.5, and the world was falling apart, right? In September, Lehman fell. Bear already fell, right? That's Bear Stearns. Most of you remember, I hope. And if you don't, you should study it. So the world was pretty much falling apart, yet why wasn't the market crashing? And what began to happen between November and March 8th of 2009 is you had extremely volatile, that's when the market started to crash. But market crashes, like I've been through the 87 crash, that was like a day and a half. This 50, 100 times the liquidity and value in our market since then. So it takes quite a while for a market to really, really crash. But when corrections come, 87 turned out to be a correction, right? You can't even see it on a chart anymore. A 25, 30-year chart, you can't see that anymore. Actually, 87, it's more than 30 years. Anyway, these are good opportunities, right? They are very scary, and they're enough to convince someone to never buy assets again. As far as crypto, nobody knows the reason why crypto is not, specifically Bitcoin, right, is demonstrating itself as a safe haven. But since this coronavirus is most prevalent in China, one can say that people have doubts over the ability for those mining consortiums to maintain hash power on the network. You don't know. But just know this, that a virus, by its very definition, is a temporary thing. And if it is largely the catalyst for a correction in asset prices, not just the stock market or gold or whatever, but in asset prices, these are the times where you have to turn your fear into faith. Because these are lower risk entry points. They have different kinds of risks. Like this could perpetuate, right? We could have, you don't know if we can have 250,000, 500,000 deaths from this virus, if it can really penetrate the United States. Do I think it will? No, I lived through the SARS scare. The SARS virus really killed the stock markets. This is turning out to be a little bit worse, right? From a financial market standpoint. But take a look, get some perspective. Corrections are the scariest thing to step into, right? You got premiums that are really, really high on options, derivatives, volatility indexes, leveraged ETFs, inverse ETFs that go up when markets go down, right? Pick quality assets that you can hold for a long time and put them away for a long time. Not investment advice. This is just kind of it's my observation, right? But if you're scared, it's understandable. And the reasons seem to be very real. That's the thing. These corrections seem so real. And that's what compels people to just capitulate, get out of here. Please, God, get me out. I swear I'll never buy another asset again, right? I'll spend more time with my family. These are the types of foxhole prayers that people go through during very, very scary moments in the history of financial markets. So I'll catch up with you guys again, and we'll talk a little bit more about this. I don't know how long it's going to last, but, we're 1,500 points off. We're at all of major market indexes, 5-6%. all-time lows in the belly of a rates curve, and it looks very scary. So I'll connect back with you. Talk to you guys later.